Are life insurance dividends taxable? There seems to be a lot of confusion about this, so let's spend some time today clarifying the subject. There seems to be a lot of confusion over the taxability of life insurance dividends. Sometimes they're taxable, sometimes they're not taxable, so how do you know when they are and when they aren't? The truth is, the vast majority of the time, dividends paid by a life insurance company to a policyholder are not taxable. This is the case because dividends enjoy a special treatment recognized as a refund of premium under U.S. tax code. Now, there are some people who try to politicize this fact and claim that the only reason the dividend exists is because the insurance company overcharged you for the coverage that they provided you. I'm not here to litigate the merits of that claim. I'm only here to talk about the technical treatment of taxes of dividends today. Dividends from life insurance companies are most commonly associated with whole life insurance policies. And this is the case because a lot of whole life insurance policies pay dividends to policyholders. But you should understand that dividends are not exclusive to whole life insurance policies. There are life insurance companies that pay dividends to term life, disability income, long-term care insurance, and annuity policyholders. There are also some extremely rare situations where life insurance companies have paid dividends to universal life insurance policyholders, and we'll talk about that in just a little bit. But understand that dividends are payable to a wider range of products than just whole life insurance, though it is much more common to find dividends paid to whole life policies than it is to the other types of insurance contracts that life insurance companies tend to issue. In order to understand how dividend taxability works, it's important somewhat to understand how cash value taxability works on a life insurance policy. Life insurance is unique because it allows the policyholder to remove the contributions he or she made from the cash value before touching any of the gain in the policy. We oftentimes refer to this contribution as cost basis, and cost basis is pretty much the premiums that you paid to the policy. In some cases, there's an adjustment made to the premiums paid to arrive at the actual taxable cost basis, or non-taxable cost basis rather. But by and large, you can think of your cost basis simply as the premiums that you paid to the policy. We refer to the ability to remove cost basis from the cash value before touching the gain as first in, first out accounting principle or cash treatment. It simply means that the contributions you made first, the premiums that you paid, can be removed before you have to remove the gain. To give you an example, let's say you own a whole life policy with $100,000 of cash value in it. You've paid to date $75,000 in premiums, so you have a $25,000 gain. In theory, you can remove up to $75,000 of cash from this whole life policy before you'll pay any taxes on the distributions from it. Once the $75,000 has been removed, the remaining $25,000 is gain and would incur ordinary income taxes if you took it out of the policy. Dividends function in a similar fashion to this because they are a refund of premium. Using this same example of $100,000 of cash value and $75,000 of cost basis, you could receive dividends in cash up to $75,000 and none of those payments would be taxable to you. This of course assumes that you don't continue to pay premiums to the policy, because if you do, you'll continuously be increasing your cost basis while at the same time decreasing your cost basis through the payment of dividends. So for example, let's say your annual premium is $5,000 and this year the company is going to pay you a $2,000 dividend on your whole life policy. If you take that $2,000 dividend payment in cash, it's going to reduce your cost basis from $75,000 down to $73,000. But at the same time, your $5,000 annual premium payment is going to increase your cost basis to, at that point, $78,000. So, while the dividend is reducing your cost basis, your actual payment of premiums is increasing your cost basis. There could come a day when the dividend payment is larger than your premium payment, and continuing to take the dividend as a payment in cash could deplete your entire cost basis. If this happens, then every dividend payment from there on will be taxable to you as ordinary income. So now that we've covered what happens when you receive a dividend in cash, let's talk about a much more common scenario, using your dividend to purchase paid-up additions. This is what a lot, in fact most, whole life policy holders do with their policies. And the purchase of paid-up additions increases death benefit. It also increases non-guaranteed cash value of your whole life policy. Doing this has a net zero impact on your cost basis. The payment of the dividend is non-taxable because even though it is a refund of premium, it immediately goes towards the purchase of paid-up additions, which doesn't impact your cost basis. It, in theory, reduces your cost basis, but immediately contributes to your cost basis through the purchase of paid-up additions. So opting for this dividend option does not change your cost basis and therefore does not have a taxable implication to you. Now, what happens if you choose to use your dividend payment to buy more life insurance? Does this create a taxable event? The answer is it depends on how you go about purchasing more life insurance. If you're using a whole life policy that has the ability to purchase term life insurance with the dividend payment, sometimes this is referred to as the fifth dividend option, this is not a taxable event. Because again, even though you're technically reducing your cost basis through the dividend payment, you're also immediately making a contribution to the whole life policy to purchase term life insurance, and that goes towards your cost basis, and the net impact is zero as far as your cost basis is concerned. So there is no change, there is no taxable event by virtue of using your dividend to purchase term life insurance on top of your whole life policy, so long as you're using a feature inside the whole life policy to do this. If, on the other hand, you're using your dividend to purchase a separate policy, doesn't matter what type of policy it is, whole life, term life, universal life, if you're using the dividend payment to purchase a separate policy to your original whole life policy, and the total dividends that have been paid under that original policy, paying the other insurance policy's premiums, exceed your original cost basis to the whole life policy, the original whole life policy, your dividends moving forward will be taxable to you. So even though you're building up cost basis in a separate policy, the fact that you have depleted your entire cost basis in the original policy will make the dividends payable on that original policy taxable to you as ordinary income. Now, can the dividends paid to you on a term life, disability, long-term care, or annuity product become taxable to you? In theory, the answer is yes, but practically speaking, it's nearly impossible for this event to take place. This is especially true for term, disability, and long-term care insurance because those products are not designed to ever pay a dividend so large that it would eliminate the cost basis that you have contributed to those policies. Instead, dividends are paid on those products more as a way to minimize cost over a long period of time for owning those products. Again, term life, disability, or long-term care insurance. When it comes to annuities, generally speaking, the dividend is used to reduce the amount one would contribute to the annuity. That sounds weird. Let me explain some technical detail about dividends payable on annuities in most cases. I'm not aware of an insurance company that issues an annuity that you could buy on a non-qualified basis that currently pays a dividend to the policyholder. Instead, the annuity products that I'm aware of that pay dividends are specialized annuities for 412I, or actually what are now called 412E3 products, which are specialized pension products that certain small business owners purchase. The dividend in this case goes towards reducing the contribution amount the business owner or plan sponsor must pay into the pension plan. I'm sure maybe someone is aware of an annuity product that pays a dividend on a non-qualified ownership basis, and if they come along to this video and want to leave a comment, that's fine. I'm just not aware of any today that currently pay dividends in this fashion. So in this case, it is highly unlikely that we'll see a circumstance where a dividend paid to an annuity will ever become taxable to the policyholder. When it comes to universal life insurance, the payment of dividends is extremely rare, but it does happen. Usually this happens with mutual companies that issue universal life insurance products where the cost of insurance charged ended up being much higher than it needed to be. What the company does is it pays a special dividend as an interest payment, usually to the policyholder, as a very unique one-time or on-occasion thing. So again, in this case, highly unlikely that it'll ever become a taxable dividend payable to the policyholder. The really important thing to remember and understand about life insurance dividends is that the vast majority of the time they are non-taxable. The only time they become taxable is if the cost basis in the policy has been removed. If this is the circumstance, then dividend payments moving forward that are taken as cash will be taxable as ordinary income to the policy owner. If you have any questions or comments about this video, that's what the text box below is for. If you like and subscribe, we'll help you understand life insurance like nobody else. Thanks for watching, everybody.